Hello and welcome to the market update here for Tuesday, August the 1st. Obviously, the market keeps kind of grinding higher, and Thursday we had that bearish reversal candle. I was at the point where I was going to kind of just sit back and wait for the pullback, and the market just isn't pulling back. And even with some of these pretty strong signals of pulling back, being in an overbought condition, getting a pretty strong bearish reversal like we did on Thursday, it's just kind of baffling. Now, it can be frustrating sometimes when you have a certain expectation for the market, whether it's bullish or bearish. Now, I would always argue that as long as you've got a sound reason to believe the market should go up or go down based on either technical analysis or fundamental analysis, whatever you subscribe to. I'm assuming anyone in this class is more of a technical analyst because this whole software is trend following and looking at the charts and things like that. But there are going to be times where you're going to be frustrated that you're expecting the trend to continue and it reverses, or you're expecting it to reverse and it continues. These are just part of the ebbs and flows of the market. It can get frustrating at times. Every trader will get frustrated at some point in time. You don't want to be frustrated all the time. If you're frustrated all the time, it means that you're probably not using very sound analysis, especially with a trend following type system. You should be able, if you can identify that trend, you should be right about that trend direction most of the time. But that's what makes a market, is uncertainty and lower probability moves. The thing that's kind of got me over the last few weeks has been the number of lower probability moves that have taken place. I liken it to being like in a poker game, and your opponent ends up with 4 aces on 3 straight hands. What is the likelihood of that happening? Pretty much impossible. And you start to wonder if he's doing a little bit of cheating there. There's something unusual going on there because of so many low probability outcomes. And that's kind of sometimes how I feel about the market right now. Is something being manipulated or something like that. Now, as it relates to market manipulation has happened through the whole history of the markets. And I'm not saying that necessarily manipulation, as long as it's legal, I'm not saying that it's bad. It's part of the game. It's kind of like, when you're playing a basketball game or something like that, and you try to grab the opponent a little bit here, see what you can get away with, slow them down, bump them a little bit. Those could be called fouls, but boy, with any if you're calling every single bit of contact, everyone would be fouling out of the game. So you try to get that edge within the rules of the game, and that happens in the markets as well. There's deception is part of sports as well. You try to, as a football play, you try to deceive the defense, making it look like you're going to run the ball, and then you pass the ball. So when we talk about, market manipulation, sometimes that does happen. It's usually with the big players. An average retail trader is not going to be able to manipulate anything, but there will definitely be times when big fund managers want you to buy what they're selling. They want to get out. They want you to buy what they're selling. To do that, they need you to believe that stock is going to go higher, so that the price will at least stay where it's at, if not go higher, and they can sell as much as they can sell. And this can happen at times in the market when you get near these tops. Now, big fund managers aren't immune from sharp declines or big massive declines when they start. They feel the pain of those as well. But usually the brunt of the downtrend or the downward sell-off is usually felt by the lower traders or the retail traders. and that's just the way the game is played. The big fund managers are usually going to know information that you don't know, and like I said, when they're trying to get out, they will do what they can. They'll have stocks upgraded at the top of their move. You think, oh boy, there's a new price target. They think their stock's going to go another $10. I missed the first $20 move of the stock. I better jump in right now and catch the last $10 move. And you're probably buying from that big fund manager that's unloading at that time. Now, the reason why I'm talking a little bit about this up front is that, I haven't been this frustrated that I can, well, I shouldn't say that. I was pretty frustrated back in February it was April and May when the market moved completely sideways. I'd never seen that before for that long period of time. That was pretty frustrating. But before that, as it relates more to what's going on right now, that was more just the market not moving at all. But I remember back in the summer of 2008, and there were so many signs that the market already started to kind of just decline. There was news coming out, Lehman Brothers went under, or Bear Stearns went under. They were the ones that went under first, and these bank failures, and people were worried about a real estate bubble and all this stuff and how that would affect the banks, and the market just kept grinding higher, and it felt like something bad was coming, but the market just kept kind of grinding higher, and I remember being underwater for the year at that point, and then being really frustrated that the market wasn't doing what it looked like it should be doing, and it dragged out for several weeks before finally, obviously, in the rest is history. We got that massive sell-off in late September and through all the way basically through the next year into March, where it finally bottomed. But the point I'm trying to make is that sometimes you can see some of these divergences. You can see some of these little clues that are leading to some sort of a pullback or correction, and they just don't necessarily happen when you're expecting them to happen. And again, that's part of what makes a market is it's got to keep you on edge. Can't make you so completely confident that you start risking everything and you start making tons of money. It's the market will find a way to make you uneasy. Everybody has to deal with this. All right. Now the software does help alleviate some of the emotion by kind of just not taking into account news and things that are going on, but just what is the price action doing. As far as the direction alerts, momentum's backed off a little bit here, so we're not in that extreme reversal risk box here. So it's telling us that there still could be some more upside based off of the momentum. And even in that extreme reversal risk, usually it's the right side of that box that we start to get concerned. Breadth has moved into the extreme range, but again, still not to that far right side. And sentiment should be at the far right side of this. I still have to find out what's going on with that algorithm there. It's been stuck on that buy area here for a while, and it should be at the far right side where it's been completely complacent. But our buy sell ratios aren't unusually stretched. Sentiment is pretty close. Like I had mentioned last week, it wouldn't take much of a move higher to get it to that extreme range there, and so that's something to keep an eye on. Now, as far as the charts are concerned, we've talked about this resistance area, and to watch for that. We're just below it, and that's kind of what threw me from last week was that you don't have to reverse exactly at the resistance area. We were close enough to it, and then I'll zoom in again. I'll talk about that bearish reversal kind of we saw on Thursday. But this is an area to keep an eye on, and it is starting to show some signs of sluggishness here. Now, it did that kind of before where it hit this area. It kind of got sluggish as it hit this area, busted through, and kept going. So, again, this is not suggesting that the market can't keep going up from here. And what I've really been talking about a lot lately is not necessarily that there's going to be a big correction, but that there should be at least some mild correction to the trend we're already in. It's kind of hard to buy into kind of a stretch condition. That's kind of what my argument's been for the last few weeks. But this was that bearish engulfing candle right here that we had on Thursday. Again, very significant from the standpoint of it gapped up higher. Looked like, it was breaking out of this range right here and then suddenly reversed. A lot of that was focused on the Bank of Japan and what their policy was going to be. And since then, I think it's worth noting that we're still inside of that candle from Thursday. Now, some of the indexes, it has broken that candle. We'll look at that here in a second, but it's kind of remaining in this area here. And so what's nice about this is you can use this as a kind of a bullish above, bearish below type of indicator here. If we were to, one thing I've always said is when you have a bearish reversal candle, if you can move above the top of a bearish reversal candle, it wipes out the momentum of that candle. So with this bearish engulfing, if we break out above here, it basically wipes out the momentum of that reversal, makes it insignificant. At least in the near term, it makes it insignificant. It's worth noting that you start getting some of these reversals that reverse right back up again. They could be kind of warning that things are slowing down or things are setting up for a pullback. Again, if you think of it, like I mentioned in the beginning of the class, those big fund managers, they're trying to unload some of their stuff, sometimes by selling to retail traders or what have you. They're buying. It could create an initial reversal type candle, and then maybe they stop selling for a little bit, and those retail buyers keep buying, and it pushes it up a little bit higher, and then they try to sell again. And so that's what I see when I see some of these reversals that don't reverse, is it could be setting up for something bigger to come. When they're done unloading their shares, then there's no buying left to keep it up, and then at that point it can drop pretty sharply. And so, if this candle could still be significant if it were to drop from here and break below the bottom of that. If you look for triggers, there's a lot of big earnings coming out this week, Apple and Amazon and some of those stocks, AMD, I think today, that could be drivers of that. So that's something to keep an eye on here. Basically, though, today we're just down slightly. Yesterday we were up slightly. Let's take a look at the Dow. The Dow is traded above that reversal candle on Thursday, but it's tucked down below it right here. It'll be interesting to see how that closes. If it closes a little bit lower from here, you've got a little bit of a bearish shooting star candle, but we've seen a bearish shooting star candle right here and another one right here that didn't hold. So again, I don't have as much confidence in bearish reversal candles at this point of this run, and maybe that means that it's really close to pulling back when I start to lose faith in the price action there. So the Qs also kind of traded a little bit above that reversal candle on Thursday, but have been closing below it or right at it for the last couple of days. Again, we'll look to see if it breaks out. Now there's another resistance area here on the Qs that it could rally up to. And then the Russell had a strong move yesterday and did break out of that reversal candle, closed above it, in fact, and then it's right back down below it again. And it actually is down the biggest percentage of the indexes today, although it's off the lows of the day there. A little bit of a hammer formation right there. Although hammer formations, they work a little bit better when you've had a little bit larger decline. When you're on the day of the decline and you're creating a hammer candle, they're not as effective. But so I see a lot of indecision right now in the indexes. And there should be with some of the things that the market could be concerned with. One of them is the bond market. Bond market signaling that things are not as great as a lot of people out there are saying. One thing we've talked about, we've been watching, and I've talked about this for a while. Let's go to a 2-year chart. We can see a bigger context here. We had been trending sideways, and so we had really kind of passed over the TLT chart a number of times. We talked about it back here when those bond yields spiked up, but it held, that support held. And as of today, we're trading below that support level. If it holds, we have an hour and a half before the market closes. If that holds, that'll be a significant break. Well, let me go back to the 2-year chart. So what that means is that the probability now is that we will work our way back towards these lows right here. Now, why is that significant? Well, remember when we had the decline all last year, that's what was happening is bond yields were rising, the TLT was going down. Again, if you look at where those October lows were, you had the October lows, the market had rallied since then, and then the bond market wasn't signaling anything stronger after that. The market kept going higher, but bonds kept just moving sideways. And now bonds are working their way back down towards those October lows. That's something to pay attention to, and the market at some point will start paying attention to that if it continues. And a few weeks ago, we started looking at that 10-year bond yield chart. You can't pull that up on TradersPro, but if I can pull it up here on my other charting service, and I talked about that 4% being significant right here. And again, we were close. We're at 398, 397 all through here and all that. But again, this gets into that pricing, the psychology of pricing. You know, $200 is expensive, but $199 is a sale and it's cheap. Well, it's only a penny cheaper, right, or $1 cheaper. But it psychologically plays with your mind a little bit. That's kind of the way this has been playing out. Is when people see 4%, that's significant. Now, why is that significant? Well, because if this continues to go up, and you've got a market that's getting overbought, these big fund managers are going to look around and say, "Hey, what's the likelihood the market rallies, 10, 15% into the end of the year with no pullback? And if there is a pullback, you've got to hope now you can get that back through the end of the year and be 6, 7, 8% up for the year. You got to hope that happens." But the alternative is, why I could just go into the bond market and get 4% right now, and I've got my 4% through the end of the year. And so there's that tendency for those professional traders to pull their money out of the market and put it into bonds. Now, the average retail trader doesn't usually do that, but obviously the big institutional trader is the one that moves the market anyway. And if they decide that at some point they decide that it's better to grab that high yield as opposed to take the risk, the risk-free yield as opposed to have the risk in the market. And I don't know where that is. I mean, again, these guys have their own models, what they look at, and I don't know what's going to trigger it. Maybe it already has. And again, that's what we're seeing is they're unloading. That's why we're kind of grinding higher, is they're unloading stuff and they're upgrading markets and talking bullish on the market to until they've unloaded their positions and who knows, maybe that's what's taking place here. But it's worth noting that as long as these yields keep creeping higher, it's going to start to have that effect on these big institutional traders. So that's something we're going to start keeping an eye on again. Now it got above 4 right here, and as soon as it got above 4, it pulled back. Could the same thing happen here? Absolutely. So I'm not suggesting it just because it's back above 4 again. Although it's interesting that it's back above 4 again just shortly after it hit 4 for the first time in several months. The fact that it's right back up there again is definitely interesting, especially with some of the commentary out there. And again, I don't pay too much attention to this because I don't go study this stuff. It's kind of a waste of time. But there are some people that their forecasts are looking at possible signs of recession or slowing will show up in the fall. There are a lot of people are pointing to the effect of well, gas prices for one, being an inflationary effect, but also the student loan, people having to pay back their student loans starting in the fall, September, October. Obviously, that's going to affect the consumer spending power and things like that. So, maybe that's when that stuff will start showing up. But you got to remember that these big professional traders are not going to wait for that if they're going to be moving into bonds or something like that. They're going to start that before those events start taking place. So, well, anyway, we'll keep an eye on that, see if that changes significantly. But I thought that's worth noting today that we've been looking at that area for a long time, and we finally have broken through that. Obviously, we could rally back up to the highs of the day at the end of the day and close right at the support line, and but it's not looking like it's going to do that as of right now. So I think that would be a significant break of that trend. Gold is still looking corrective. It's kind of back and forth right through here. This is looking a little bit more impulsive off the bottom. We'll see if that's the case. If this is just a correction for another move higher. If the dollar keeps moving higher, though, that's always a headwind for commodities. And you got oil. Oil's been going higher. Let me go over the dollar real quick, though. The dollar's been moving up pretty sharply. I pointed this out in the previous class that maybe there's this move up, and maybe this is just a deep ABC correction. Now, typically ABC corrections don't retrace 100% of the move, but that's something to kind of keep an eye on there. Let's back out and look at a longer term chart here. Well, it could be that this is a wave A, and this choppiness right here is creating a wave B. Maybe it rallies a little bit up in the near term, and then you get a wave C down or something like that. I don't know, but it could be moving up in kind of that bowl-shaped move, higher highs, higher lows through here. We'll see if that. I think this would be significant if it breaks above this area here. I think it's a little ways away from that, so we'll keep an eye on that. Obviously, if it breaks above here, that'd be bullish. If it comes down and breaks below here, that'd be bearish. But that could and that could have a little bit of an effect. The market's kind of been rallying a lot stronger when the dollar's been falling. It's not correlated completely to the movement of the dollar, though. So you can have a dollar rising in the market up to. It's not going to be. It's not like the commodity dollar relationship. But a weaker dollar does help a lot of the multinational companies, and there are a lot of multinational companies right now that do business throughout the world. burned enough times where you don't believe some of the stuff that gets talked about over and over again, you know. And someone's made a comment that my screen is frozen. I haven't moved it yet for a little bit, so let me see if can you see me moving it at all. If I can draw something on here, and it might not be on my end too. So if I'm getting a number of you tell me it's freezing up, then I'll know it's on my end. But it might be on. I have to check your internet connection to see if it's not freezing up on your side. But all right, the VIX is, I point to Thursday again that what caused me to really think that reversal was significant was we had a bullish engulfing candle on the VIX at the same time, and the VIX really hadn't been moving much. It had been kind of creeping along here. The bigger moves have been to the downside, and then we have this big bullish reversal candle on the VIX. I still will take that trade, let's say 9 times out of 10, because there might be the one time where I've been beat up too much to take it. But that's 9 times out of 10, you're going to get some sort of a pullback off of that type of behavior. Bearish engulfing on the S&P, bullish engulfing on the VIX. And maybe it's just delayed. Like I said, we're still kind of trading within that candle, and here we're still kind of trading within the candle here on the VIX. But VIX is up a little bit today, which you would expect. The S&P is down, the VIX should be up. So really, the VIX isn't telling us anything significant today. Not that I would really point to, and it's off the highs of the day as well. I think we're going to need to, 30 is what we kind of point to, or 20 is actually an area of complacency. I think we need to get up to 17, 18 before any sort of bearish move has significance. We're going to need to see that VIX up above there. We're at such low levels right here. And the thing is it'll probably get up there very, very quickly within a day or two. And if it does, then that's going to be significant. Pay attention to that, because it tells you that that hedging is really probably starting to get pretty aggressive at that point. All right. All right. So let's move over to the SMH. Now, this could be affected by AMD's earnings coming out. I think it's today after the bell. I got too much I'd pay attention to focus too much on earnings reports. I guess I can here. I can pull it up. This usually tells me when the earnings are. Yeah, it looks like today. That could have an effect on the chip move here. You're bumping up a little bit against this resistance right here. It has kind of moved sideways again, and normally you would expect that it should break out at least. It could break out and reverse. But the way it's behaving right now, it's looking like it should move higher. But with earnings reports, you could go either way. And if that does have if there's a negative outlook on AMD and it causes the other chip stocks to sell off as well, which can happen during this period of time, that could lead to a decline there. I think what's more significant is the transports in relation to the Dow. Transports have been kind of just going up and up and up, which has been a bullish sign. Today was probably the most significant reversal that they've had in a while, possibly closing below the low of the previous day. Haven't done that since back here. And so, you know, it is off the lows of the day as well, though. So, but that's something to pay attention to. Maybe an early sign. What you would look for there, since the transports tend to lead the way, is does it start declining stronger than the Dow Industrials? And if so, that could be signaling a little bit of a decline in the industrials, possibly. Bitcoin's down a little bit today, although it has a little bit of a bullish hammer candle. I did get stopped out of my Bitcoin trade, although I might just get back in again if it can show some strength out of this. This could just be a deeper correction, but this looks impulsive, and this definitely looks corrective. And then you're getting that bullish candle right there, bullish reversal candle right there. But I usually don't like to see that big of a gap and then get the bullish reversal candle. I like to see a little bit more of I'd like to see like a big down day, and then get the candle. You know, this is an example. You get a gap down, and then maybe get a reaction out of that, but it's not as strong of a reversal. It maybe hasn't flushed out all the sellers yet. But overall, I still like the longer term chart on Bitcoin. All right. I didn't get a chance to look at too many positions. Well, let me bottom line it here. So take a look at the S&P right here. You know, it hasn't reversed. It's showing signs that it could be pulling back, but it hasn't. We're still not on the indicators at the far right side of the extreme reversal risk. So, you know, you don't want to add a ton in a stretched condition, but you could add a few things right here in case it continues to move a little bit higher. I didn't get a chance to look at too many stocks on the new buy list here before class, and not that I would want to add too much, but this BT right here, I like that it looks like it's coming out of this corrective pattern right here. Nice little run up. That's a pretty cheap stock. I don't know too much about it, but that's a pretty decent pattern. Let me back out and look at a little bit bigger context here. Yeah, I mean, look at this is what I'd love to see. This kind of bowl-shaped behavior here. Looks like it's moving up the right side of the bowl. Kind of a corrective move right here. And the stock has been up, you know, $12, $13, $14. So the reward to risk here isn't too bad. So let me add this one. Let's put a stop in at about 3. That's up low right there. I don't want to take on too much risk there. So the low is 362. We'll just say 355. Price at 355. We get 2,000 shares. Yeah, 2,000 shares. Yeah, I don't like the percent. I'm still within the portfolio at risk percentage. I don't want that to be above 1.5%. But the dollar per, if I get stopped out, I'm going to lose $1,700. I don't love that. So let me go with, I'd be okay with about half of that. So let's do 1,000 shares. And then another one I liked was C3AI right here. I kind of looking to see if it could break out of this range, which it looks like it's doing today. This could be, you know, a target area could run up to this previous high right here, and that would kind of line up with the market going a little bit higher if it does go a little bit higher. all of these, I'm just looking to see if I could, ride a little bit of a later move here in the market that does continue to go higher here. If it doesn't, I'll stop out. I kept my SQQQ inverse ETF. I got out of the SARK one, stopped out of that one. But I'm going to keep the SQQQ as just a little bit of a hedge for these new positions in case the market reverses. And then I'm just going to put a tight stop down below this range if we come down below there at all. And to be honest, if we start seeing the market sell off significantly, even if I'm not at my stop, I'll probably just get out of these because I'm only looking to try to capture a little bit of a momentum move right here. And so that stops about 36.45. Let's do 200 shares. And still, that's too much risk there. Let's do 100 shares. And get into that. All right. And I think I'll keep it at that for now. We're sitting here at about 150. Yeah, we've been kind of hovering around that 150. Yeah, that's fine. We're kind of in this late stage here. All right. That's all I have for now. We'll have more stocks that we can look at. I'll have a little more time to do that on Thursday, and that's more what the Thursday class is for anyway. And we'll get a chance to see, again, what we'll be looking for between now and Thursday is do we break above that that top of that candle. That would tend to be a little bit more bullish if we do that. And we'll see what happens. All right, thanks everyone. Have a good week. We'll see you Thursday for the stock specific class. Bye now.